And we are live. Thank you. Welcome. I got a screen share here. I'll try to get through the pleasantries really fast because we have a really good group of speakers and a big group and a lot to talk about. Okay, 12th annual Chicagoland Multifamily Apartment Summit. You know the date because you're here. I want to thank all of these sponsors one at a time, but we would be here for another 10 minutes if I did. This is fantastic, folks. I say this every time. We wouldn't have been able to pivot to these online events, wouldn't be able to pivot back to live again, crossing fingers, without the support of groups like yours, helping us put on these events and make sure we're information sharing amongst our viewers. Okay, this is us, RE Journals, in case you didn't know. 6 publications, 17 states. We do about 150, we'll probably get to 200 events this year, depending on COVID. So today, state of Chicagoland multifamily apartment market. Before I stop screen sharing, just hold please. I'm going to show you one more thing. This is an innovation our tech team put together. This is our virtual version of a lobby, the best we could do, instead of being live, booths and such things. But if you go here, this is how you got to this event. You probably clicked on watch event here, so you probably already know what you're doing. But this is where you can find out about our speakers and the topic they're going to talk about. You can learn a little bit more about our sponsors. And if you're like, hey, I don't know what that group does, you can scroll down here, learn a little bit more about what the company does and connect with them. But most important thing I want to point out, networking's not dead online. There's a LinkedIn button below everybody's name. You see I'm highlighting the little red LinkedIn. Click on that, and at least you can make a few connections today with our speakers. I'm going to kind of step out of the way. Ralph, are you ready to rock and roll?
Yes, absolutely.
Okay, so I'll be here if y'all need me. Just say, hey, Todd, I need something. I'll be listening in the background. I'll also put up those slides with your contact info as you're talking, but take it away.
Good morning, everyone, and thank you for joining. My name is Ralph DePasquale. I'm the managing director at Berkadia and the investment sales team. I'll just spend a minute talking about Berkadia. Hopefully you guys all know who Berkadia is, but one of the largest multifamily lenders in the country, as well as investment sales platforms. I think we did about 30 billion last year, even in a little bit of a down year. Basically Warren Buffett's commercial mortgage group, and we bought out Hendricks and Partners a few years ago. And as of earlier this year, you might have seen the news that we also merged with Moran and Company, so to give us an even larger institutional presence on the multifamily side. Anyway, that's a little bit about us. I want to let our panel introduce themselves. Very distinguished panel, very diverse panel of experts in the multifamily industry. And so with that, let's see, Craig, do you want to start us off with a little bit of introduction? Tell us what you do.
Sure, thanks. I'm Craig Pryde. I'm a principal with KTGY Architecture and Planning in the Chicago office. KTGY is a national architectural firm that specializes in the design of housing. We hit just about every housing market that you can think of or run across nationwide. We have 6 offices across the country, about 350 professionals. And the Chicago office, we are working in about 15 different states. I think KTGY is active in about 35 states last year. We serve clients in the single family production and custom market, as well as the multifamily for rent, for sale. That's it. I think I'll turn it over to Patrick.
My name is Patrick Tuohy. I'm Senior Vice President of Marquette Bank. My focus has been for the past 25 years, multifamily lending in regard to acquisition, rehab, new construction. We have a dedicated department just for multifamily lending. And this has been a very successful move for the past 13 years that I've been with Marquette Bank. Prior to that, I was with Washington Mutual.
Anyone else? Let's see. How about Ken?
Sure. Hi. Hi. Ken Motew. I'm one of the founding partners of M02 Properties. I've been in the multifamily infill on the north side of Chicago business literally for 30 years. So I started right as I graduated college with a company called ICM Properties, which is still around, and they do pretty similar things, little bigger buildings. So my brother and I started with about 12 properties in 2008, 9. Prior to that, I was a partner with Peak Properties, Mike Zucker, who I'm sure a lot of you know. And so my brother and I now manage and own about 700 units across about 82 buildings in Chicagoland, again, north side, anywhere between 4 and 80 units. We value add, so we take apartment buildings, rehab them, rent them, refinance them with Pat. Pat has a couple of our buildings. So that's what we do.
Great. Andrew, you want to jump in?
Sure. I'm Andrew O'Connell. I'm with Horvath Tremblay. I'm on the multifamily investment sales team, and I'm out of the Chicago office. At Horvath Tremblay, we are a national firm that's expanding into different markets right now, and we focus in multifamily and retail investment sales. And for my markets, primarily I focus on middle to lower income areas in and around the city, but a lot of Northwest Indiana and the surrounding suburbs, west, southwest, and just generally around the Chicagoland area.
Great. And let's see, Jeffrey, how about you?
Good morning, everybody. I'm Jeff Michael. I'm one of the principals of Horizon Realty Group. This is actually year 20 of me officially being in the business, and very similar to what Kenny does. Our business model is very similar. We look for value add properties in the Chicago market. Our sandbox is mostly the northern neighborhoods, all the way up from Rogers Park, down to Lincoln Park, and we have an asset in South Loop also. And we're value add guys. I indicate we have about 25 properties, comprise about 2,500 units. So we have a good beat on what's happening predominantly on the north side of Chicago, at least. And that's about it.
Great. Is that everyone? Did I miss anyone? Sorry, I didn't see I think that's everyone. I believe. Anyway, obviously everybody's taking a big exhale or inhale, whatever you want to call it. Been a very interesting 12 months. It's been hard to believe. It's hard to believe that we started all this a year ago, March. And certainly the city has seen some dramatic shifting around of multifamily demand because of COVID-19. Vacancy rates very high. On the other hand, suburban market seems to be doing very, very well. I mean, do you see this sort of temporary phenomenon, or more of a permanent paradigm shift to suburbs versus more urban? And I know we have a couple of guys that focus more on the north side of the city, more neighborhoods. Love to hear more about the impact of that, versus even downtown versus the neighborhood areas. So I'll throw that out to maybe Jeff. You want to start sort of with that question?
Sure. Yeah. There's a lot to unpack there. A lot of what you said, I think, was absolutely true. I think we've all experienced at the beginning of COVID. There was basically a mass exodus out of a lot of pockets of the city. And I think the areas that obviously got hit the most were the Loop, South Loop, West Loop. And it was interesting, as you trickle north in the city, geographically, the impact you could see was less and less. And by the way, you make it all the way up to, like, say, Rogers Park, there was substantially less impact on that exodus movement. So we have a building in the South Loop that I mentioned, historically been at 95% occupancy. I don't remember what the exact month was it was, but we had 70% occupancy. I don't think that building had ever seen 70% occupancy, since it was probably originally built. And then those numbers got much better in terms of occupancy and vacancy as you migrate north. So my feeling is on where it's been and where it's going. I do think it's going to be a glimpse, as opposed to more of a permanent movement. There was certainly that urge, that feeling, people wanting to get out, get more space, and in the height of COVID, be in a safer environment. But the promising thing is this early season, I'm a big numbers guy, so I ran some stats just to kind of see how we're doing. And statistically, we're looking good compared to this exact time frame last year. Just an example, in our own portfolio, our applications are up 7.5% compared to the same period last year. Our leads that we're generating are up 19%. Our overall CRM activity, you know, just touches with people and communications are up 25%. So those are the positives, which is good. But overall, our percent leased of apartments is still down about 7.5% compared to this period last year, which means basically, yeah, velocity is up, but we have a huge hole to climb out of. So it's sort of a mixed bag, but you know, also anecdotally, I talk to my property managers. It's changing week to week, frankly, too, and they seem to be a lot busier now. And funny thing is, I installed in my office here, we have a gong. I actually bought a gong because I wanted to hear every time we lease an apartment. They hit the gong.
That's
and
great.
This thing's just been ringing. It's been ringing like crazy, which is good. So that's a good sign. You guys might hear it while we're on this talk.
I love that. Let's hope so.
So, you know, if I can speak, you know, Jeff and I have similar buildings. Jeff has little bigger buildings. We've seen, you know, when COVID started, we have never, and I know this is going to sound crazy, we're almost zero. We have been 0%. We've almost had no vacancy for 30 years, literally. So COVID hit, we went from literally having not a vacant to probably 10% of our portfolio was vacant, which we've never had. And now, you know, I did some numbers from beginning of the year. We've rented 76 apartments across, you know, 700 units. We're down, but here's the interesting thing. We're down 12.5% in our rents. You know, we were $162,000, those same apartments last year. They're now per month, $141,000. So we've given away 91 free months worth of rent, and we've rented 1,027 months since the beginning of the year. So what we're seeing, and we're back up, we only have 1% vacant. So we're also able to pivot a little bit, work with our renters, give free months, take away move-in fees, you know, but we are seeing a significant drop in rent. 12.5% is a decent amount. And what we are seeing is we're heavily loaded with one bedrooms while they're renting if they have outdoor space. And they are, you know, we're now when we're rehabbing stuff, we're adding like Murphy beds into, you know, building in desks into units. But we are seeing a big pickup in velocity. Like I like that idea, Jeff, of the gong, a great idea. But you know, we're renting probably the most apartments we've ever rented in 30 years between January and now, ever.
Yeah.
But the rents are down, and we're fortunate that we've locked in rates when the rates were low. But it's not, you know, we're seeing, and someone had talked about earlier, bigger apartments, Jeff. I don't know, we're seeing one bedrooms are harder to rent. The twos, one bedroom plus dens are much easier to rent right now.
Right. And then to underscore kind of what Kenny said, yeah, these statistics are great. And as he alluded to, velocity is up. But yes, I think most developers and landlords across the city have, figuratively speaking, dropped their pants in terms of concessions. I mean, our concessions have basically tripled. We were at 2020, our concession was about 0.7% of our GPR, and now it's about 1.9%. So yeah, you're going to see overall aggregate revenue down, but at least we're getting heads in beds as a start. And the nice thing is when they're taking these, I don't know about you, Kenny, the concessions that we're offering are locking into longer terms. You know, we'll offer 2, even 3 months free rent on an 18-month lease, and people are taking the bait on that, which is good. So hopefully we'll see some counterbalance of that perhaps on our expenses in terms of turns of apartments should go down because you're turning less units, you're locking them in, less leasing commission, that kind of thing. So hopefully there'll be some offset to that.
Yeah, and we are, Jeff. Yeah, you know, for the first time ever, we're doing 14, 18-month leases. I've never done that. So you do a 14 or 18-month lease, give away 2 months free rent.
Right.
And so you're right. And then I never thought about something Jeff brought up as a turnover expense, which every time a unit moves, it costs us $3 to $4 grand. So, so if we can keep those tenants longer, and payment, something that Jeff, I think is relevant for everybody here, is our payment across the north side, Jeff, like we didn't have a single eviction in the entire year, and literally, I think maybe one person, and we have 1,000 tenants, did not pay rent. and we had to work with them to get out, and that's it. So we were very fortunate on payments. Everyone paid. Like our collection was almost 100%, 99%.
And that's great. That's good news to hear, actually. And that was actually a question that one of our participants in the panel was asking on the chat line here. But it was about about a year ago that everybody started focusing on collections. I think you guys just talked about that a little bit. How are you seeing collections going forward? Over the next couple of months, let's say. Really, last year about this time, April, May, that's when everybody took a pause and said, well, are people going to be able to continue to pay their rent? I just read a statistic this morning, I forget where it was, that nationally, as of March 6th, I think 80.1% of residents have paid their rent on a national basis. This is through the NMHC. How are you guys seeing that?
A survey of all of our top operators in the last few days, and good news is they're averaging anywhere from 94 to 98% collections for March, which was a very positive surprise.
That's great.
And they don't see any change for April. The other thing was that obviously the winter was dead, like they've never seen before. But in the last 2 weeks, the activity has really kicked up.
The activity in what, Pat? In rentals?
Yeah, as far as people actively looking.
Yeah, we've seen
last 2 weeks.
Yeah, we've seen, and I think Jeff will speak, like I've never, like usually once like really September hits, it dies. We've seen more of a constant from September till now than we've ever seen in rentals. Like we don't usually rent apartment in December or January or February. Well, February something, but like we've been I said we rented 76 units since January 1st. I would tell you the last 30 years, maybe I've rented 10 a year. So, because I mean, we all have friends, kids, our own kids who are at home, who didn't have jobs, who want to get out of their homes. And so we are seeing that. I mean, all of my kids, I have 5, 2 of them were at home. They're now not at home. A lot of my friends' kids are all downtown now. I'm seeing, and I don't know if anyone can speak for this, but the high rises, I'm seeing like a friend of mine's kid just rented a 3-bedroom in a high rise on 200 East, I think, Illinois, $5,000 3-bedroom. She rented for $3,300 a month. That's a 40% decrease in rent, almost. Like, I don't understand how that works. So someone can explain that, because I don't, and now, which was never Jeff and I's competition, that becomes our competition for the next year, because people who would never look at high rises are now looking at those buildings because the rents are so significant.
Well, I just talked to Landstar Leasing. They've got 25 agents, and the deals that were extraordinary over the winter, and that has changed. They said as of the last 2 weeks that the extreme offers are being taken off the table in the last 2 weeks. So that's all quickly changing.
Right. I think there's a lot of people that anticipated, going into the leasing season, it'd be a little rougher maybe than it is. It's still not, terrific, but it's a lot better than it's been. And we've heard that as well on the concession side, that it's gradually getting less and less, it seems. But, obviously one of the major impacts of COVID, Craig, I'll put a question to you. Have you seen any effects on, from the last year, an actual design of and what people are looking to build these days?
Sure.
In terms of apartments.
Yeah, I think that the biggest influence that everybody's seeing is, I think unit sizes are trickling up, especially in the smaller units. We used to be trying to drive down unit sizes to increase density, especially in the urban core markets. Suburban product always seemed to be a little larger in average unit size, but I think across the board, units are getting a little bigger as we're now looking to provide work from home space or some additional usable area within the unit. I think the other thing that we've seen is in the suburban market, at least, the demographic has changed. It's not just the young millennials. There's a higher propensity to include some larger 2-bedroom den, 3-bedroom units in those products, especially in the more affluent suburban market, where you're looking to attract the empty nester that wants to stay connected to the community but get out of their single family home. They've either got 1 or 2 other locations that they spend their time with, which is creating a slight increase in demand for the larger units. The design of amenity spaces is a little different because it's smaller groupings based on COVID rather than large assembly spaces. That's been the biggest change, I believe.
Yeah, I've been hearing, I think we mentioned it, somebody mentioned it early in the conversation here, about, build to rent is becoming more and more. I know it's a little more prevalent in the Smile states, but I have a meeting this afternoon, in fact, with a group that's looking to do some in suburban Chicago. Have you seen some of that, or I'll open it up to the panel?
I would say
if you've talked to anybody about that as well.
Yeah, we're seeing a strong increase in the build for rent market, and it's our clients that were doing, say, typical multifamily, whether it would be a suburban 3-story walk up or outside the suburban core. And now we're looking to do 1-bedroom cottages, small lot developments of 2 and 3-bedroom units. And it's basically speaking to the fact that people, they still want to rent, but they want some connection to the outdoor. They want some outdoor private space that's not necessarily a balcony. And it I believe is a strong response to, COVID. Just, you need some outdoor space. You need some different way to connect with your neighbor, other than a balcony. And so it's been a big uptick. I think the production builders, the typical build for sale clients are moving into this as a way to increase revenue and put a different product out there. It's exciting. It's small lot development. It's a bit of a challenge for communities that are not used to seeing it. So we're having great success in working through a lot of those issues. But I think it's going to hit the Midwest. Again, it's been very prevalent in kind of the warm weather states, but it's starting to become a very viable option in the Midwest for a lot of developers as well.
Yeah, I agree. Again, just starting to dabble into that a little bit with some investors / developers. In fact, as I said, I have a meeting today to talk about that very topic with somebody. But it's an interesting period. And I'm going to shift a little bit of our focus to interest rates. Obviously, rates were a big part of what drove investments. I always say if the multifamily wasn't the darling child of the industry before, it certainly is now and going to be going forward relative to some other product types. And we saw very competitive acquisitions, again, pre-COVID pricing towards the end of last year, end of last year. How do you think interest rates are going to affect that going forward with rates, being up a little bit over the last, month or so, I guess, and going forward?
I mean, me personally, I think we're walking a tightrope when it comes to rates and deal flow. Some deals that I see are literally only make sense because of where rates are, and you could get some good IO term for 12 or 24 months. So you could get that, that cap rate that or at least that IRR that you're looking for on a deal, because you can play obviously with cash flow and can make the numbers work at virtually any IRR, depending on how much IO term you get on a deal.
Right.
What scares me is what's going to happen if you're looking at a 5-year deal 5 years from now, where rates are going to be, any uptick in that rate, because these deals are just so tightly underwritten, is going to be dangerous, I think, for the market as a whole. So I don't know, Pat probably has more of a sense than I do.
Well,
I think one of the biggest factors that we've seen surprisingly over the last 6 months and right up till recently is the lack of opportunities and product. So there is a real imbalance right now between the potential buyer and the potential seller. The amount of opportunities out there for, active people in the industry is not that good. So when a good property comes on the market in a good submarket, and if there's not a ton of deferred maintenance, there's a lot of buyers for it. But Jeff, I concur with you that when you look at some of these deals trading at a 5 cap or 4.5 cap, and with the treasuries this morning at 1.51, and they've been at 1.6 recently, that margin is thin. There's no question about it. So if the market, if we're saying the market's a 5 cap and the treasuries go to 1.75 or 2%, you're going to see, I believe, a reversal on those cap rates. I just think they'll go back to 5.5 or 6. What do you think, Ken?
well, I was gonna ask Jeff this, like, when COVID hit, we had 7 deals. We killed every one of those deals. I'm sorry, every one except 1. So, and then so in the last year or so, Michael and I would buy, I think we were buying 12, just say a building a month. We were buying for the last like 10 years. Now COVID hit, we bought one in the entire year. Since then, we are closing on, I think we're closing on 2 or 3 in the next couple of months, but those deals work regardless. And Jeff, I agree with you, and Pat, the interest rates I'm running, we've never done this, but we're running, I'm saying if interest rates go to 5 or 6, how do the deals look? Or, I think we went to 6.5 on one of them, percent, because most of so to go back, deal flow, Pat, you're right. I still don't understand how people, and I think Jeff would agree, some people look at these buildings and they buy them, and I'm like, I don't know how they make it work. I mean, if interest rates go up a little, they're going to be in big trouble. I don't get it. So, Michael and I have always stayed away from buying stuff like that. But if interest rates, look in the last, we just locked a deal in at 3.43% for 10 years with Freddie, right? 3 years interest only. That same deal today is at 3.93%. It went up half a percentage in 2 weeks, literally in 2 weeks. So, and then you go look at the numbers on the deal that we refinance. I mean, it doesn't affect it that much, but it keeps going up. It will affect it. I don't even like the stuff that's being thrown out there, and there's a lot of it. Very few of it, I think, makes sense. And Jeff, I think you could speak as well. I mean, Jeff looked at a building we wanted to sell. I mean, it works if you can borrow money at 2 or 3%. But honestly, it probably didn't at the time, because our rental rate for that building went from $1,900 a month to like $1,700 a month, right, over 80 units. Now we're getting back up there, but interest rates scare me. Most people aren't worried about it. I am worried about it.
Yeah, and it's even more compressed in other markets. You have some of these secondary markets, Nashville, some of the Sunbelt markets, Tampa, Orlando. Rates are compressed. Cap rates are compressed even more over there. So it's predominantly cash buyers or people coming in with very low leverage that can make these deals work right now.
Yeah, we've definitely seen a shift not only from an occupancy standpoint out of the city over the last year, but also on the investment side of the house. A lot less transactions being done in the city, Ken, as you mentioned, and Pat. We've seen that shift to either the suburbs or in my case, we do a fair amount of business in Wisconsin, Madison, for example. Where we just did a deal that sold for a sub-4 cap. So it's an interesting time. Andrew, have you seen? I know obviously you guys are on the investment sales side as well. What have you seen in that respect in terms of opportunities and where money is being shifted to?
Yeah, for sure. So for most of my business, we kind of focus in the, kind of the outskirts, not like the urban infill locations. So southwest side of the city, Northwest Indiana, kind of middle and lower income areas. And really, kind of going back to the beginning of COVID, there was a lot of concern because a lot of those tenant bases are the ones that were probably hit most by the job losses, service industries and the restaurant industries. And, from an occupancy and vacancy standpoint, there was a lot of concern from owners, that tenant base would be really hit hard. And, with all the owners that I work with, kind of across the board, they never really felt that shock that they were expecting. Most owners really sustained occupancies above 90% kind of throughout the marketplace. They've had some issues with some non-pays, but usually they work with them, and they've been staying. And obviously, once the eviction rules change a little bit, we'll see how that goes. But I mean, we've seen tremendous demand, really, kind of throughout COVID, and now, I think a lot of the housing is driving some of that. The housing costs in Northwest Indiana are up like 10% year over year. You're seeing a lot of that in the suburbs and around the city. So, I mean, the demand for suburban, I mean, really kind of what I hear a lot is not in Cook County. So people are really trying to look for properties, whether it be in, Northwest, Southwest suburbs, areas outside of Cook predominantly, but certainly like workforce housing and affordable housing in Northwest Indiana, which is a very low supply market. We've been, kind of different sizes across the board, but, properties in the past month or two or 3, we bring them on the market, they're gone within a week, or we're getting bids above ask in some cases. And some of the properties have in and around the city, not exactly that situation for sure. While, they're still performing pretty well, I just think that the investor demand is not quite as strong for areas in the city as it is, outside the city, or even kind of in the middle income, lower income, because you kind of have a lower rental base. So you're not going to be able to really cut rents too long. But the housing demand increase, I think that there's an intrinsic rise in rents that could be projected in the future.
Our suburban portfolio has seen a pretty significant increase in value, surprisingly, over the last year. Properties that 2 years ago were appraising at 75,000 a unit in far western suburbs are coming in now in north of 90, 95 for B and C type product. So and those vacancies are down and occupancies are up. So it was definitely a very positive move for the suburban market, no question about it.
Pat, are you seeing a change in appraisers' approaches to properties in the city in terms of how they're underwriting?
It's interesting. I mean, they're still, we're doing a lot of appraisals lately, and they're still just doing drive-bys. So there's a lot more questions to the operator and to the owner about, finishes and rehab and what's been done to the property, asking for photographs. So it's a different dynamic the way that they're doing their job, but they're still, these are still aggressive prices, and the values are still coming in. And I agree with everyone that a lot of these transactions that I look at, to me at a 4.5 or 5 cap don't make sense.
Well,
There's no room for error.
Well, I was going to say that. And then here's a question. We met with somebody yesterday, a bigger developer. I think one of the biggest issues I just saw someone put in the chat is the taxes. Like I'll give you an example. We had a building, again, I go back, Jeff looked at it, that the taxes were 310 grand. And, KE put them there, went to Board of Appeals, they dropped down to 190 grand. So, I mean, that was a huge win for us. But the reality is no one has any idea where the taxes are going to be. I've been doing this 30 years and I have smaller buildings. Jeff has bigger buildings, so he can speak to that. Like, we don't see a 6 flat go from 12,000 in taxes to 25. It just doesn't happen. It goes from 12 to 15 or 14. So I think, and the guy we met with said the biggest uncertainty is if we had a certainty in what the taxes were going to be, that would help me underwrite something and want to buy it. But I mean, we're using numbers at 15% of gross income. I have no idea. If I really go across my board, like we're at like 10% of gross income is where our taxes really are. But Pat, you do this, like, the debt coverage ratio to loan is now at 1.3 when we go to Freddie. We're 1.3 they have to be at. Taxes, they're running taxes at about 13% of gross income. But then you talk, what are you running them at, Pat? Are they 15%?
Well, good question, because looking at a transaction right now in Park Ridge, the taxes, I'm underwriting the taxes at about a 25% increase after purchase. And it's got to work. You're right, because these are long-term owners in a number of these smaller properties in the suburbs, and their taxes are below where they should be. And that after acquisition that they are going to go up. So I'm in one particular case, I'm looking at about a 25% increase at least. And
Yeah,
that's,
but it's a long-term owner.
Well, with the new owner.
Okay.
Well, Illinois, as you guys know, may know, hopefully, that obviously is precluded, quote unquote, I say quote unquote, from chasing sales. It's a state statute. You can't do it. It's not to say that they don't look at sales, but you have to take more of a uniform approach to taxes. Even pre-COVID, I think one of the biggest, we saw a tremendous decline in multifamily sales in the city itself because of that uncertainty of that tax bill coming next, actually the assessment coming next year. Northern Cook, at least now we're seeing some of where that's coming in. We did a fairly substantial tax study for Northern Cook. While the assessments have gone up because of Board of Appeals and mill rates coming down, I think on average, we're seeing about a 27 to 30% increase in taxes, which is not great, but, certainly not the 100% increase that we've seen prior to that. So how do you guys, how are you looking at the impact, potentially the impact in the city next year when you're looking at deals?
Well, yeah, I think I'll chime in, like Kenny and Pat alluded to, until there is some understanding as to what the methodology is going to be, it's obviously going to impact deal flow, because it's sort of a double whammy. One, you're dealing with just the absolute dollars of what are your taxes. And two, you don't know the methodology, as Kenneth talked to, of what it's going to be. What do you underwrite this number to? And you can't seriously take a look at a deal unless you just underwrite extremely conservatively. At a property in Evanston that the assessor increased it by 300%. Went to the Board of Appeals, reduced it down to a 1% increase. Doesn't make sense. So it seems like the assessor's got one agenda, the Board of Appeals perhaps, or Board of Review has another agenda. So until we know where that's going to shake out, you're going to see deal flow, just at least for the much larger deals, institutional investors, kind of take a pause, I think, until that's settled.
Yeah, absolutely.
I would agree with Jeff. And then just sorry to interrupt, because and I go back to one property Jeff looked at as well. We thought we'd have no problem selling it. And I think the biggest, and it's a bigger deal, and we thought it would be gone within a month or two. And literally we pulled it off the market, and it's because the bigger people they have no clue what the taxes are going to be. I mean, when you take a building that we had that was 310 grand and now it's 190,000 in taxes, that's a huge difference. So we're trying to sell it at $310,000 in property taxes. Now I'll go put it back on the market at 190, but then I'm going to get the question, what's going to happen in a year or two? Because just give us some certainty or tell us how you're going to do it. And wait, Ralph, you said something about you're not supposed to look at prior sales. That's how we were told by the board, by the KE, when he raised it to 300,000, that was based on our sales price.
Yeah, and obviously they're not supposed to look at prior sales individually. I mean, they can look at sales across the board, but from a state statute, you can't just increase somebody because their property sold, for X to that level. But you can look at the neighborhood and say, well, all these other buildings are selling at X, and so yours is going to go up to that much as well. But I'd be happy to share, that information that we put together if you guys are interested in taking a look at it. But that leads into, and I know I'm trying to look at the time too, sorry, because I know we only have a limited amount of time, but that leads into another question, kind of related to the taxes, and I'll just open this up to everyone. But, obviously we saw a lot of turmoil in not only the country, certainly the country, and Chicago was no exception last year, but what do you see as the biggest threats, if you will, just to the overall investment market, multifamily market in Illinois, specifically, in Chicago, Illinois in general. I'll just open it up to whoever wants to start that.
Biggest threat. Well, everyone's talking about everyone leaving. I think what scares, we're doing a new construction near our office. We're closing on Monday. We've been working on it for literally, we delayed this purchase for a couple of years, and it's true. And she was great. We were grateful that she allowed us to. And our investor literally the other day said he'll help close the land, but he's not sure he wants to build because he's scared of what's going to happen in Illinois. That literally is what he said. He's got plenty of money. He's like, I don't know what's going to happen. Are people going to come? Are they going to leave? What's going to go on with the taxes? We don't see it. And I think Jeff will speak to in the areas we are. I am seeing the most rentals we've ever had in the last 3 months. Pricing sucks, but more velocity that I've seen in years. I mean, because people don't want to stay at home. I mean, whether or not everyone loves working from home and going to the office, like my daughter went back to the office. She's like, I'm so happy to be around other people.
Mm-hmm.
I believe, and maybe I am more optimistic. I believe people are coming back to the city. I believe we're going to see. It's going to take another year and a half. I think we'll be okay. I mean, Chicago is a great city. We don't rely, and I don't have, but we don't rely on one industry in Chicago. We've got plenty of industries here. Now life science is a huge thing, right? I mean, it seems like life science is a big push in Chicago now.
Right.
So I think my issue is everyone's talking about everyone leaving Chicago, how the state's messed up, politics are messed up, which are all true, yet we're renting more than we ever have, and people want to get out of their homes. So
I have a slightly different view than Kenny. I'm more of a glass half empty kind of guy. I think, yes, it's a great sign that rentals are up right now, but it's sort of like, it's that weather versus climate argument that people have. They're like, well, it's 60 degrees out right now, and then they claim that there's obviously global warming is 60 degrees out in March. I'm like, well, that's weather versus climate. Those are two different arguments. It's the short term versus the long term. It's great that velocity is up right now, but long term outlook, I hear so many guys, I'm sure Kenny, you do, of guys that we know that are in other markets, literally weekly checking out, whether it's Nashville, Denver, these secondary and tertiary markets. And they're like, I'm done with it. It's just so much easier to do business elsewhere. And we could talk about this for about an hour, as you guys all know on the panel, how COVID has changed people's expectations in terms of how close they have to be in proximity to their office or near it at all. They can work remotely. So many people are realizing, I don't need to be in Chicago. I could be anywhere. So we're losing people not only to other states, but as we've talked about in this panel, we're losing people just to our suburbs. So there's a lot of competition out there. But yeah, Chicago's got all the potential in the world. It's a beautiful city. It's got the sports, it's got the theater, they got the culture, but we got to get our act together. It's not, it's been a lot of talk, but we really got to get our act together. I saw some stat that Illinois ranks number 37 out of all states in terms of business friendly environment. You layer that on with, the taxes that we've been talking about and all the other regulations. Cook County just passed a new pro tenant ordinance that had a whole litany of things in there that limit how you can do business. It's just, there's only so many punches that landlords and investors can take where they eventually, you know what, I'm out, I'm off to somewhere else, another market where I don't need to bang my head against the wall.
Yeah, we're seeing that as well. I mean, a lot of our clients that we're working with, not only in Chicago, but throughout the Midwest, the next project opportunity is not in their own backyard. We have clients that are looking in other hotter markets that just are kind of more friendly to development or just have more demand, either because people are moving there. We have clients in the Midwest that are looking in the Phoenix market, in the Denver market, in the Nashville market. They're in Florida, they're in Texas. And some of these clients are clients that never would have looked outside Chicago 10 years ago. I mean, because Chicago was the market, but there's less and less market in Chicago. So they're forced to look elsewhere just to, keep the business going. I think the other thing that we're seeing in the suburban market, and it's a topic that's really hot in Chicago, is affordability or attainability of housing. As people move and create new product in the suburban market, it effectively creates affordable housing because it brings new product to the market. And then what was an A property slides to an A minus or a B property. And so there is some rent stratification. But I also sit as a village trustee and in the western suburbs, and all of a sudden, 5 years ago, when you're looking at a new property or a new product coming in, there was really no discussion of affordability. And now there's a discussion of, well, how many of your units are affordable and what does that mean? And so the population is becoming more educated or more interested in the topic, but policy is lagging way behind. So while there's no requirement to provide it, and what does it mean? Are you looking for tax rebates or incentives? And so the new buzzword is kind of workforce housing, because it relates to that middle market of renter that is really not finding capable product. They can't rent the brand new market rate, and they don't want to rent the really bottom end of the market. So that's been kind of a challenge to the suburbs as well, is dealing with affordable properties, and creating attainable housing. Again, the rental properties are becoming attainable to those empty nesters that want to move out of their larger home but stay connected to the market, and they want to get out of paying an annual tax bill above and beyond their mortgage and just make one payment. So that's what we're seeing.
And the workforce housing has become, obviously, and we sell a fair amount of what is classified as workforce housing, but that definition changes quite a bit over the course of the last few years. I mean, we're selling a deal in West Dundee right now that's essentially a Class A deal that's really being touted more as a workforce, kind of a higher end workforce housing deal, even though it's newer construction, because the rents are $1,400-$1,500 a month versus $2,500 a month. So it's an interesting phenomenon there. But I think that the tax situation for sure in the Chicago area is a very I don't want to call it the 800-pound gorilla, but it's definitely there. But somebody had commented on the chat that it's really a statewide need to really reform the tax code on a statewide basis, not only just Chicago, because it's different from every municipality you go to. It seems like every county is a little bit different. Cook County is its own animal in and of itself, but Andrew, have you seen that in other parts of the state as well? I mean, in terms of the taxes?
Yeah, I mean, for me, because the triannual reassessment for a lot of the south and west villages has come up in the past like 12 months. So I've had 2 or 3 deals that got hit with their triannual assessment while we were under contract.
Mm-hmm.
So your contract, you're through due diligence, and then the triannual assessment comes in. And, one deal, it was, 170 some units, and, our taxes went up 50%. And this is, you get the triannual, but that doesn't allow the new owner or the existing owner to know what the reassess or the appeal value is going to be. So we've had to kind of negotiate, during the triannual assessment. And it's, fortunately, we were able to negotiate that out to just kind of do an estimation of what the appeal will be and close an escrow. But I mean, there's some deals and this deal that I'm talking about now is I recently underwrote it, and it's, lower income, hack or HAP contract, but definitely, far south suburbs, and it's, low income area. And, the taxes on their reassessment just came in from, their taxes went from $310,000 a year to $720. And we're talking about a property that doesn't have a rent probably over 10 feet. So, I mean, my discussions with the owner, he's like, well, do you have any idea of where the appeal value will come? And, I can guesses of what I've seen on appeals on other properties that are similar, but to go double your tax burden on a property, I mean, the idea is that you can't pass that on to your tenants. Your tenants can't afford that. Like, I mean, really, that type of tax hit And I told this in the discussion. I mean, you might as well close your doors. Like, you know, he said, if they're going to leave it on me, I'll file BK, because it's just not a profitable business to absorb a $410,000 hit in a property that has little to no upside in rent. You know, and the property's running at 20% vacancy. So, I mean,
Wow. Yeah.
And I've got 55% on a deal that I'm marketing right now. The assessment just came in. So it's currently, for me, it's a problem that I'm dealing with extensively.
Mhm.
And, you know, it's the timing of getting the assessment, and then, you know, the timing to appeal revaluation. You know, no one really knows when they're going to get it back. And sometimes it's quick, but oftentimes it's, you know, it'll be done after the close or not closed, I guess. But I mean, for me, you know, that's an issue that I'm always trying to navigate and trying to make sure that, you know, the seller knows and also the buyers are aware of the potential burden, you know, going forward.
Right.
But, yeah.
I wanted to get to a couple of questions that I saw from people on the chat, and one of the things we were going to talk about as well. Obviously, there's been a huge push for condo deconversion over the last few years with the pricing on apartments versus condos. One of the questions that somebody had posed was, what are your thoughts on condo reconversion, I guess, or going back to a condo market, either on the development side or bringing some of those back? Or do you see more deconversions going on, going forward? I'll just open it up to whoever would like to chat
I
on
look
that.
at these deconversion deals, and there's a similar thread that I see. A building that was converted, 20, 25 years ago, the association within that building, they did the minimal. They kept the lights on, they keep the common areas clean, but they did minimal upkeep on the bricks, the windows, you name it, the roof. So what happens is 25 years later, all of a sudden, these major infrastructure issues come up. The building needs to be tuck pointed. The windows are shot. The roof has been patched continuously for 20 years. There's major improvements that need to be addressed. And now they're looking at, special assessments in the tens of thousands. And they're like, I'm not paying that. So all of a sudden, values drop. Units start selling, significantly less than what they were 10, 15 years ago. And all of a sudden there's a desire to sell the property at a set price. But the buyer, on the other hand, an example, I'd looked at a building right down the street from DePaul. But we got to, by the time I got to $1.5 million in deferred maintenance, we said, okay, enough, we're done. It's just the numbers didn't work. The roof was shot, the brick was shot, the windows were shot. The elevator needed to be completely rehabbed, and on and on and on. And of course, every unit is different. Some people renovated them, some haven't done anything since they purchased it. So by the time you get done with it, it didn't pencil. So it's obviously it's a one-off deal. Do I see buildings going the other way from a finance standpoint? I see that you're going too far out on a risk curve. As far as, well, how many units are you going to sell before this thing makes sense? And in the past, Fannie and Freddie have been shy, to say the least. I don't know if that helps, but.
And we've definitely seen more. I office in the South Loop, or not South Loop, South side of the Loop, and certainly seen signs going up for new condo developments that are being built. I don't know if you guys noticed any more of that in terms of new construction for condos recently.
I can see this. I've seen, and this is just anecdotal from people. Every person I know is looking north side for a condo. We have 2 or 3 guys. They put offers in, and they're gone. They're for multiple offers. So I'm hearing that the condos are selling in the smaller buildings more. We have a broker who works for us, him and his wife, every time they put an offer in on the north side, it's gone. Like in Wicker Park, they've put 5 offers in on condos, like duplex, they're gone, and for over asking. So we don't do condos, but I am seeing that. And as Pat was alluding to, a lot of these older buildings that still want to deconvert. We met with a guy next to our office on Milwaukee. They want double what we think is worth, double. and they're all and they're, like you said, every unit's different. Some are rehab, some aren't. Deferred maintenance, roof, tuck pointing, like so. I mean, to answer your question, I'm hearing the condos are selling on the north side, and deconversions are still happening, but they want a lot of money, and it makes no sense. So,
Craig, a question from you, or for you, I should say, on the design side. Are you seeing any changes in parking requirements? I guess has to do more with urban properties than suburban, but
Yeah, short answer is yes. I think in the urban markets, there's a growing trend to reduce the amount of built parking or structured parking that's paid for. More people, especially in Chicago, you can rely on public transportation. The suburban markets, yes, there's a trend to reduce parking, but there's also more of a demand to store parking. So, while people are moving out of the urban market to the suburban market, they may not be coming with a vehicle, but if you're already in the suburban market or you're moving down, there's the need to store vehicles. So I would say we're seeing a slight decrease in the suburban markets. However, there's the balance between having to have parking available just to rent the unit, because in a suburban market, if you come in with a highly aggressive parking ratio, maybe at 1 car per unit or less, there's been some tendency to not be able to rent the unit because there's a fear of not enough parking. So it is a balancing act. I would say from a design standpoint, we're trying to design parking when we do build it as a structured parking, such that we don't park on a ramp. So down the line, if there is an ability to reduce parking demand greatly, then we can repurpose that space to something else, because we've got a flat plate to work with, and we've got an environment that we can create and repurpose. Hard to do when you're parking on a ramp because you can't repurpose a slope space into occupiable space. So.
Thanks. Quick question for Patrick. Are banks right now offering tighter loan to value ratios, expanding those? What's your thought on that?
Well, I got to say that it's really bank specific. What I see is, going into the pandemic and COVID, how did the bank's portfolio perform? I have colleagues of mine at banks that were heavily invested in restaurants, health spas, hotels, retail, and, obviously have been hurt. Banks that were more heavily weighted towards multifamily have done well. But then I've got colleagues of mine at, not to name names, at the largest lender in Chicago, and they had a challenge because they're on a national platform. So they had some real challenges obviously in Manhattan and San Francisco, but that affected the entire platform. And quote unquote, I heard firsthand that Chicago was their bright light in the entire portfolio throughout COVID. So that's kind of interesting. And the reason is because in my perspective is that, $4,000 or $5,000 a month in Manhattan for 600 square feet of love, same thing in San Francisco, and they can move to, Pennsylvania or North Carolina or whatever for $15 a month for triple the space. It made a lot of sense because they don't have to go to the office. Chicago, on the other hand, we're one of the most affordable major markets in the United States. And I think that, to Ken's credit and to Jeff and to several other people that I work with, they provide real quality, affordable housing, and it's held up well, and it will continue. That is the recipe that I see as the most stable moving forward. Clients that I've worked with for many years that understood how to really succeed in this business long term, put the money in these business as far as the amenities. Now you have the technology. 20 years ago, you couldn't put a washer or a dryer and a wash machine and a dishwasher in a vintage building, but now you can. And that's what the the millennial wants. He wants a washer and a dryer, and he wants a dishwasher. But with the new technology, upgrade the electric, you're off to the races. Do you agree with me, Jeff?
Absolutely. Yeah, you hit it on the head. It's all about the amenities, and you have to keep up your properties to keep those renters interested, because there is a lot of supply and obviously a lot of the new product out there. But yeah, you couldn't have said any better. The technology is a huge component for people, even if it's a matter of putting your Nest thermostats, it's the keyless door entries, it's putting the all-in-one washer and dryers. If you can, really tight units where you got to get as much as you can in as possible. Accommodations for packages. We've talked about all that stuff in other panels and seminars, but yes.
I think that's the biggest one, Jeff, is the packages. We have troubles in the small buildings, and we've had more people get stuff stolen. I do not have a solution in the 6 flat and 10 flats what to do.
Right.
That has been an issue. You have bigger buildings, so what are you doing?
So we're converting spaces to package rooms wherever we can. And then there are services that are popping up that will help manage the delivery of the packages so that they'll be able to come and your residents could schedule with them. I'm sure you're aware of those services out there too. So there's different, avenues that are popping up, but it's certainly more of a challenge in the smaller buildings where you don't have the space to accommodate it.
Right.
Hey guys, I just noticed what time it was, and I know some of the next panel is gathering for their start. I wanted to just, I'll throw out one quick question and maybe a 30-second answer for everyone. When do you predict that we'll get back to semi-normal living?
Open up the sports venues, open up the restaurants, get people out of their houses and their apartments. Let's get out, and that's where it's going to change.
Yep.
Great. Walking down Southport yesterday, people were out. You could see a vibe that you didn't see in the last year. And we need to get over this hump of not having sports venues, not being able to gather. And and hopefully, and it looks like in the next few months, we'll, God willing, we'll be past this.
Knock on wood. That'd be great. Well, I want to thank everyone for participating today, our esteemed panel here. Thanks for everyone that's online and listening in as well. I'm going to, I think, turn it over to Todd, I believe, and we'll go from there. Thank you very much.
Thank you.
Thank you.
Thanks, everybody.
Thank you.
Thank you.
Everybody.
We are cooking with gas this morning. Good, great panel. I think you guys could have gone on for a couple more hours.
At
Hopefully this next group picks up where you left off. Just want to do a couple screen shares here. If you're on the next panel, now's the time to activate your camera and your microphone. Make sure it's all working. I'm just going to do a couple housekeeping items. Reminder that this lobby here, hopefully you're seeing that, is where you can learn more about these panelists. Connect with them on LinkedIn by hovering over here and hitting the button. Learn more about what they're going to talk about and hear from our sponsors. Appreciate that. Last point I want to bring up is the chat room. So below all of these amazing people, you should see a button that says chat. If you haven't already figured that out, pop that chat button open. That's where you can ask questions, but you can also network with the people that are online with you. We have several hundred people on this event this morning. Good event. Thank you for joining us. But you can network with them. Go in there and put your name in there. Hey, where are you from? What's going on? What are you working on? Anybody have a question? The only thing I have to caution you on is make sure there's a drop-down menu right above where you type in your question. And it says to, and it defaults to all panelists. So only the panelists are going to see it if you don't click on that and choose all panelists and attendees. So thank you. We've got our moderator, Lisa. You look like you're ready to go.
Yep, we're ready.
Excellent. I'm turning it over to you. I'll be back in an hour to wrap things up.
Hi, I'm Lisa Skolnick. I was a reporter in this industry for almost 3 decades. I've authored 16 books on housing, and I now have a marketing and public relations firm called Purpose Brand. But we're here to talk about the issues, and I have an incredible panel, but I want to thank the panel right before me. They were very interesting. And Ralph, you taught me something new. I never knew about drive-by underwriting. That's a new one on me. I found that astonishing. So it's certainly been a momentous year, and this is a momentous day, given it's the anniversary of the pandemic being officially declared. Our sheltering actually started on March 20th. And thanks to this pandemic, renters' preferences have changed, probably exponentially, and maybe forever, but definitely for quite some time to come. Renters want more space, different space, services instead of amenities, and much more, as my panelists are going to tell us. I have an incredible panel. Each of them have deep market knowledge. We spent an hour going over all of the things that they had to say. I'm going to introduce them alphabetically and let them tell you a bit about themselves. And then we'll do a deep dive into design, construction, management, and leasing trends. So Richard Davey, I'd like you to start. Tell us
Hi, everyone.
about
Richard Davey. I'm with W.E. O'Neill Construction, project executive. Been with them my entire career, which we like to think says a little bit about us. You see a lot of that here. W.E. O'Neill's general contractor. We work nationally across several offices, Nashville, Colorado, Arizona, and California, in addition to Chicago. And so we're seeing a lot what's happening with multifamily across the country.
Great. Kristen Larkin.
Hi, good morning. I'm Kristen Larkin. I'm the interior design director with Fitzgerald. Fitzgerald is, let's see, we're 102 this year. So we have a very deep history focused on multifamily residential for developers. We're based here in Chicago, but frankly, we're working all across the nation now. I'm excited to be here today. Thank you.
Robert Mueller.
Thanks, Lisa. Thanks to RE Journal for organizing this event. Robert Mueller, managing partner and lead designer of Chicago office of BKV Group. I spent 23 years as a practicing architect in Chicago, designing projects locally, nationally, internationally, in practice areas, leading with multifamily, but also commercial office, hospitality, mixed use, higher education, transportation, urban planning. My firm, BKV Group, is a holistic multidisciplinary firm. We have practice sites in Chicago, Dallas, Minneapolis, Washington, D.C., and Hanoi, Vietnam. We were founded by Jack Borman in 1978 as Borman Architects, and we've grown from a sole proprietorship to an international firm with 175 employees. We're a holistic firm, architects, structural and mechanical engineers, interior designers, and landscape architects. And we're focused on building multifamily communities, market rate, student, affordable, and senior living. So excited to be here and take part.
Milan Rubenstein.
Hi, Lisa. Happy COVID anniversary. I'm Milan Rubenstein. I'm a real estate investor, started in 1998 by being an apartment manager, worked my way up to owning about 2,500 apartment units, a retail office, and I have done a lot of adaptive reuse in the last 10 years. Currently own in Chicago, LA, Panhandle, Florida, and Texas.
And Andrea Upwood.
Last but not least, with the U last name here. Thanks to everyone for having me. I work with or for Captivate, and Captivate's known for about 12,000 elevator and lobby displays across the US and Canada. We've been in business for 25 years. Most recently, our push has been to help the multifamily buildings that are experiencing a higher volume all day long with their communication and wellness technology solutions. I've been here 4 years and I handle the whole Midwest. So Chicago is my home, but I also handle the Pacific Northwest and Northern California. But most recently, I've started working on my WELL AP accreditation.
Well, I think it must say something that you handle California and you're living in the Midwest. So clearly we're not that bad, despite the taxes. So my first question is, and I'm going to be calling on each of you because I know you all have something specific to say as we've discussed. So first, how are changing demographics affecting design trends? I'm going to start with you, Kristen.
You know, I think Honestly, we can probably all say we've witnessed some mini migrations over the last year. We've seen people moving from city to suburbs and really beyond. A lot of that has been around, safety and wanting more space generally just to take care of ourselves if we are going to be trapped. But I think a lot of it has just been the freedom that those of us who are fortunate enough to be able to work remotely were able to enjoy. And so the pendulum kind of swung towards that kind of more balanced lifestyle. And what people seek to support that is going to change naturally. So we've seen changes in amenities. Now these buildings aren't just our home. They are our bunker. They are a delivery hub. There's so many different things. They're our office. So that is going to naturally change. But the biggest reason for all that at the root of it is health and safety. And so what we believe and foresee is that there's going to be a continued desire and focus on health and safety, not just, are there hand sanitizers and, is cleaning happening, but just how does this building really support my wellness, my health, my balance. Mental health is important too. Andrea, I too am also studying for WELL AP. So it's definitely a trend we foresee. We're getting more requests to explore fit well and well in our buildings.
Great. You also mentioned earlier when we spoke that size really does count and bigger is better. So
yeah, I mean, it's interesting. Obviously, if people are spending more time in their house, they want more space, especially if they're doing more in that space. But I think the biggest thing that's driven that is price. Right now, we are seeing, because of that migration, we are seeing the prices are coming down. So people that could afford a studio maybe can afford a 1-bedroom, and they're taking advantage of that. So we're seeing people gathering in bigger bubbles and renting a 3-bedroom. So the demands are shifting in terms of the unit mix for sure.
Okay, so Milan, I hope what Kristen just said doesn't mean that people are already negotiating rents with you. They probably are, but you had some very interesting things to say about this too. So I want you to tell me about it. Tell us about it.
Yeah, the price is people are definitely negotiating. Like the previous panel spoke about, the concessions are higher than ever. We're trying to combat that with longer term leases. So for 18 months, we give, 1 or 2 months free. But I think the older demographics, these empty nesters that used to want to come downtown for the arts and entertainment, for the restaurants, for the retail, and now we have none of that. The retail is boarded up. I think those are the people that rented 2 bedrooms from me, for example. And also I had roommate situations. So the 2-bedroom was a popular design as far as the units go. But now, and then the younger crowd wanted these studios and micro units. We've done a lot of SRO conversions. I've even thought about partnering up with a operator that did shared living. And basically, nowadays, the 3 bedrooms and the 4 bedrooms that were not popular ever are now the most in demand. People want space for their office, extra room for their reading and work. So now that shifted. So my small units are not popular. Nobody wants these studios. People want 3s and 4 bedrooms that were totally not in demand. And I think that's the biggest change. And as far as the location, people want more close proximity to the outdoor space. So if I was going to design one right now, I'd do it with larger floor plates, more views. People didn't care about the views. Now people want more windows and views, different amenities.
So Robert, you also as an architect have a lot to say about this. Before Robert starts talking though, I want to point out that he is coming to us from an incredible home of his own design that is in the city, which shocked me. So those gorgeous clerestory windows and all that light is all from Robert's brain. Okay, Robert, you're on.
Thanks. Yes, it's a joy. Love my family and I love living in the city. We live in Edgewater, city dwellers for 23 years now, and raising our kids here. But that's not the only place to live. Talking about demographics, first thing is Chicago proper as compared to other major metros. One thing about us is there's lots of land here. There's room to grow. The other aspect, as compared to, say, coastal cities, for example, is our proximity to the Great Lakes can tend to mitigate some of the effects of climate change. So, coastal areas are going to be affected by that more acutely than what we're going to see here. And that, I think, is a strong long-term prospect for Chicago. Within our area, there's a lot of trending towards the suburbs, the first ring suburbs and the outer neighborhoods. We call it suburban. So the idea is to form a sort of city center, or to find a small city center outside of the actual city, and use that as the basis of your smaller community. So you get those active things that you would get to some degree in the city, but at a smaller scale. And typically you can get a bit more space the farther out you go, because the land values are lower and the rents can be lower. And that's something that's happening. And I think part of that also is due to the fact that commuting is becoming less of an issue, especially people are now working from home. And that trend had begun before COVID, but it really got accelerated with COVID to a point where 2 to 3 days working from home is not uncommon. And that's leading to this trend. But there's a counter trend as well, or a corresponding trend, which is this goal of attainability. And young professionals are looking for housing that fits into their budget, allows them the lifestyle that they want, and in a location that they want, where there's activity and energy. So those micro units and smaller units, we're still seeing clients asking for those kinds of design ideas in closer to the city centers.
And Robert also talked a lot about the importance of flexible multi-purpose space because of the fact that people are working from home more often. I'm now going to go to Andrea, and I've been in this industry a long time and learned something new from Andrea. So Andrea, tell us about your project and how this relates to design trends.
Well, you asked about changing demographics affecting design trends. And I really think that as the demographics change, we clearly need to design for the demographic, whether it's a young couple, a single living in a unit, or a family of 5 looking to find a 3-bedroom place. I think that we have to follow the amenities and follow exactly how do those demographics communicate. We have to, are they having 700 Amazon packages delivered? Are they not doing that because they want to support local business and have a more sense of social justice? It depends. So when it comes to the changing design trends, I can certainly say that the way generations communicate and the way that different family structures communicate is really something that property managers and owners, developers need to think about as they're designing these new spaces.
And you also said to me that Andrea explained a lot about her, about the critical importance of digital media in multifamily. And she said it's really critical to reinforce communication with it, and that the large format screens have become ground zero for so many of the communities that she services. And that's kind of a critical point. I was bowled over to think about that because I never think about that.
Yeah, I wouldn't either if I didn't work here.
Yeah.
I mean, when you walk into a building, you're always looking around, right? Am I going to the elevator? Am I going to the package room? Am I going to a common space? Am I looking for the management office? It doesn't matter. Even if you live there, you're always looking at things as you walk in the building. So any chance that a property manager has the ability to reinforce social distancing, reinforce pick up your packages because we're overflowing, reinforce safe practices, and here's what we're doing to make this building healthy, safe, and create community for you to ultimately retain those tenants, right? Because we heard in the last panel how much it costs for turnover. The more you can retain tenants by making them feel safe, healthy, informed with any type of data delivery that they're catching is really important in this situation.
And we're going to go to Richard, who is a traveling man and very busy these days with W.E. O'Neill. He came to us for our pre-discussion panel, our pre-panel discussion on a plane, waiting for it to take off. But Richard, tell us your thoughts as well.
Yeah, I guess I'll give everyone a sense of optimism. I think a recovery is starting to take shape, and it's happening. What we definitely saw more so in different parts of the country where we have our other offices. It accelerated almost a building boom in places like Nashville and Colorado and such. But also, the hope is here in Chicagoland. The suburbs came quicker, almost immediately. And we were lucky out there in the suburbs, and what we really are hopeful for is last summer, our building owners were just devastated with vacancies. We're talking 60% vacancies and such like that. And everything stopped. Everything stopped in the city. Whereas now I think there's a very different picture that vacancy rate is going down. And what we keep hoping that'll lead to is once that absorption rate, if it keeps going the way it is, eventually it's going to cross that line where there's a need for more buildings and back in the city in a year or so.
Great. So our next question is, what types of buildings are most attractive for adaptive reuse, which some of you do? I'm going to start with Robert because you do a lot of work in that arena.
Yeah, BKV has a large adaptive reuse practice has been established for a long time now. And what we can say is all buildings have potential to be adaptively reused. In general, they outlive their uses over time and either they're repurposed or demolished. And in the 80s and early 90s, it was warehouses and printers row. So those were being turned into lofts. And now the trend's expanded to office buildings. And you can see that in for example, the IBM Plaza turning into the Langham Hotel, or the Chicago Tribune most recently turning into residential. The appeal for office building, I guess one thing is the softening demand currently for office space, at least currently. The availability of those spaces and their locations in the city centers. We're doing a study for Metropoint Tower in Minneapolis, and it really boils down to how do you address the lease depths, because offices tend to be a bit deeper than what you would need for a residential unit. And in order to really take advantage of that, you need to have a code that will allow for a bedroom with borrowed light, typically. And some jurisdictions don't allow that. The other issue with renovating office buildings is how do you deal with the facade? Because most of them do not have operable windows, and those are a requirement for residential units. So there's going to be some facade upkeep and modification in order to get that to work. The hotels also are appealing. The thing about the hotels is great is the lease depths and the organization of the footprint allays itself nicely to a residential footprint. But even in hotels, the facades oftentimes don't have an operable window situation. So you'll be dealing with that for hotels as well.
So you mentioned two of my favorite projects, the Langham. I wrote a major story on that, and the Tribune, where I worked for 2 decades, where none of us who ever worked there will ever be able to afford to live. Okay. Andrea, you're up.
The one thing that I could add to adaptive reuse is we're hearing a lot of discussion around AI and how that type of data is driving what is actually going to be consumed by the new people moving into these new spaces. So if you can collect the data on the target demographic, you're able to adapt that reusable building into a much more attractive, effective space for the demographics coming in.
That's true. Kristen, how about you?
Well, Fitzgerald also has a really long adaptive reuse history. We've done many loft conversions. Now we're kind of seeing a shift of what people are exploring converting. The two most popular are office and hotel because they are naturally a little bit, they just make more sense. To Robert's point, the deeper footprint. For instance, we converted Montgomery Ward building. Everybody knows that building on the river. The trick to making that successful was that we cut a courtyard into the center of the building to get that light into those deeper floor plates. So you have to explore kind of creative solutions like that when you're working with an existing structure, but we love the promise that it holds to revitalize these old buildings and not put them in the dump yard. You know, I mean, we really want to see, as stewards of the environment, we see it as our duty to explore those. The biggest thing we're starting to hear about is what are the options with retail? Retail's really struggled in the last 5-10 years. And we're seeing that happen in malls. So we're starting to sketch conversions of parts of malls into residential, and what that could do to revitalize the community is really exciting.
Richard had some great information about the mechanical aspect of this. So Richard, your turn.
Yeah, I think adaptive reuse is very much in the fabric of Chicago. It's what the city is right now. And I'd say we really cut our teeth on converting old office buildings into particularly hotels and hospitality spaces. And, you know, where I said there was a recovery happening before in multifamily, we're not so sure about that in hospitality. In fact, it could be going the other way. That change may become more permanent, and there could be a real glut of hospitality out there. And so, and then the interesting thing is that we see that as one of the best buildings that you can have, you know, for adaptive reuse, and in particular back to multifamily. And where it really comes down to is that unit style layout. And if you're able to figure out how to preserve a lot of that mechanical and electrical infrastructure, you know, perhaps making two hotel units into one room or 3 into 1, that there's real potential there and real cost effective potential out there.
I just want to quote Richard because he was so cute. He said, hotels are the sweet spot, and no pun intended, but you can put these together, or suites and several rooms, because the plumbing is in a good place. And after writing about this for years, I really, you know, said, yeah, that's the obvious. Why didn't I think of that? All the plumbing is in place. And Richard also addressed costs and the fact that costs are going through the roof right now. Can you just say a little bit more about that? Because that's the obvious to nobody. It's like the gorilla in the room or elephant in the room.
Yeah, the big hope was that all these prices going down. Well, it definitely didn't hit construction and raw materials. In fact, we continue to see things going up, and in some cases staggeringly up. COVID really disrupted our supply chain quite a bit, and in particular, probably everyone knows quite a bit about lumber. You know, lumber has gotten out of control, but then there's also that steady churn and cement and other building materials. So the cost pressure hasn't relieved, and it's not getting any better, and it only goes in that upwards direction. Copper, you know, which is very important to your utilities again, which, you know, again, why we think the hotel lends itself to adaptive reuse. If you can preserve all that copper infrastructure, good cost savings there.
And Milan, you even went down to types of properties, which was so interesting. Go ahead.
So from the owner's perspective, besides the obvious that hotels are hurting, and I'm looking to buy some of those and convert, and office buildings as well. I used to look at TODs. You know, that was a big word. How many steps to the public transit or major retail or how can I push the FAR? How can I get higher? How can I get an elevator so that I can build higher? or add more units. But now I'm not, from an underwriting standpoint, I'm not looking at downtown. I'm looking at more neighborhoods, at the buildings that are typically not sexy, like downtown buildings. I developed a lot in the South Loop, and now I'm looking more in neighborhoods. So I think location is more relevant right now, and I'm not underwriting adaptive reuse projects right now. I'm looking more into existing and looking forward to markets to maybe tank and take advantage of that, not going to more construction, because there's uncertainty with taxes, with construction costs, and the market in general.
When we originally talked, you also mentioned that you go for Bs and Cs as opposed to the A and the core. And one of the big things that is going on out there is that people are saying price appreciation is going to be higher in B and C properties as opposed to A. Are you finding that?
Yes, I was always B, C to B, and that's my core business. And now that's gaining more traction than the core A, or the institutional money is not looking at Chicago right now. So all of the buyers from out of town, I just sold a $53 million deal for people to buyers that are from out of town. So, and they're all in the suburbs and in the neighborhoods. I think that C and B are appreciating right now in this current market much more than A, and that's why people are not looking and making offers on these apartment buildings in the downtown.
So our next question is, what are the evolving amenities that are must-have for today's renters? And I can't help but remember that you just said something about TODs, Milan. And I'm actually calling on you first because it's your turn. And you mentioned TODs, and I'm wondering, are parking spaces still a big amenity? Because I live in a neighborhood where TODs are going up left and right, and all of a sudden people are clamoring to buy parking spaces in the few buildings that are left that have them, and they've gone up from like $40,000 to $80,000 just for a parking space.
So the so my turn for amenities. I think security is my number one amenity today. That has been never a problem before, but now it seems to be the biggest issue. So camera systems, fob systems, double doors, all throughout downtown has been the number one. The obvious is the high-speed internet. That's been there for a while, but now more than ever. And free internet, people are expecting to get high speed at no cost. So we're wiring all our buildings and not charging for that. Cleaning has been a really important one because of all the boxes and everything gets now delivered to your door. So that's been a huge issue, and I would say an amenity to have more bins and more places to put your packages. And I think I mentioned to you that all of my tenants now are into cannabis, and all my buildings smell. So changing filters to HEPA and but plugging in some of those ozone machines and cleaning up the smell has been key. And then we talked about how I combined all the party rooms and community spaces into gyms, into more gym space, because people want to go to the gyms but are not happy with the small little gyms that I was providing before. And more storage has been an issue because now people spend a lot more time at home, so they want to declutter. And I've been renting my office and retail spaces for storage. And I'm going to give you one last one, which I think is really unique. I've been offering concierge almost service to people that are struggling. So people that can't make their rent, especially my retail tenants, but also my apartment tenants, so they can call our office and we'll basically point them in the right direction where they can get help either from the city or from the grants, PPP loans. And that's been almost a full-time job for 2 people in my office.
That's really a great ad, though, I have to say. Andrea, your turn.
Yeah, of course. So hearing all of this discussion about storage and what you're doing with your buildings is really interesting, because that's exactly what we hear as well when it comes to amenities, what needs to be done right now. I think the most important part is creating a community where people want to stay. So whether that's giving them the delivery options that Kristen, I know we talked about it. I mean, I have food delivered all the time because we're not going out, and I'm tired of cooking every single meal that I eat. So delivery options, package options, being able to communicate these changes with your residents, but people are also at home much more. So property managers are running into dealing with people all day long when they used to leave their space, and now they're in the buildings all day long. So how do you effectively manage that type of communication? But most importantly, you do what makes people feel good. There's a real psychology to that, is how do you feel safe in your home? Do you feel healthy in your home? You know, again, I speak to well, but I'm kind of a nerd when it comes to the psychology and the health of a building. I think it really goes a long way, whether it's a resident or a worker in an office.
And you also had mentioned that property managers and owners are really tapping into data for occupancy projections, usage, and things of that nature, which can be used to assess how your amenities have to be tweaked as you go on. Kristen, how about you? We were talking about beyond work from home the other day.
Yeah, so Fitzgerald, let's see, it was last summer, we reached out to tenants and property managers and had a survey, and we wanted to get real-time data of what the experience of going through quarantine has been like in these buildings, and what's the cost been for both tenant, property managers, the physical building, identify those problems and you know, start to really think about what that means for the future of these buildings. So we published a report in the fall, it's on our website. But what we found, amenity-wise, what people wanted the most, to Milan's point, they missed the gym by far the most. Second to that was outdoor spaces, not just pool, but just general outdoor space. Those who had their own little private balconies seem to be faring better than those who didn't, which was one of those things that it was a nice to have. So that'll be interesting to see if that becomes more desirable. I'm thinking back to condo days where you couldn't have a condo that didn't have an outdoor space. You might be looking at an increase in private outdoor space, but also an increase in public outdoor space. And a lot of that just goes back to wanting that connection to the outdoors and the psychology that it plays, to Andrea's point, the importance that it plays on our health and wellness. You know, clean air, we spend what, 90% of our time in buildings. So how that affects us, our health and well-being, is really important. The other big thing, obviously, with the work from home surgeons is the places to go where you don't feel trapped and tethered to this screen that we all have been in a room, but that we have other places that we can go to just change up our viewpoint, our day, make us feel a little bit more active and interactive with people to the degree that we can. So having what used to be business centers, but that's so passé, but really being able to plug and play almost anywhere in the building is critical, and having those spaces that have the sound attenuation for these types of interactions. So sound and light and connection available to make that easier and more fluid for people.
I love that you take the word plug and play and apply it to work. And you said that the other day too. I thought it was so catchy and memorable. Robert, your turn.
I think we've hit on all of the big ones thus far, so I can just echo what Kristen, Andrew, and Milan said. But there's a question of flexibility Amenities are constantly changing. What people are looking for in buildings are constantly changing. There's new ideas and amenity coming up every day. So we're creating rooms that are open and flexible and can incorporate different purposes. The ability to partition spaces off so that you have the smaller zones, such as Christian was saying, with an attenuated walls so that the acoustics are appropriate for work. Zoom worthy rooms, something we talk about, which is you want to have a nice backdrop if you're going to have a Zoom meeting and you're not going to be in your office space.
Cheers.
And the technology for turning your background into a picture isn't great because the edges of your head are always getting screwed up and your glasses disappear and that kind of thing. So having an actual space behind you is helpful. The bigger gyms is a huge one. People need to get out of their smaller units, but they want to be appropriately distanced from others. And I think that'll continue. It's just safer with a little bit more distance from not only COVID, but any airborne diseases. And then well safety certification. So a lot of people are looking for that, and a lot of our clients are asking us to bring that, incorporate that into our design work early on, just to make sure that the interior environment is healthy and comfortable, and that's something that everybody's looking for.
Okay, thank you. And now we're going to talk about leasing trends. What leasing trends are we seeing in the city and the suburbs? Richard, I'd like you to answer that first. Thanks.
Yeah, I'd say the first thing we saw are projects that were in process and underway was, something that Robert just touched on. It was a rethinking of those interior amenity spaces that were put on hold, big lounge spaces out, and I think, as Robert said, a very kind of purposeful, more intimate, smaller room. I think those got broken up quite a bit. Milan talked earlier about the need for cleanliness and how that changed things. And I think two projects that we've got going right now is cleanliness of elevators in particular. And there's new stuff out there. For example, when the elevator isn't occupied, it undergoes a UV light wash, and now there's ventilation systems in these elevators, which wasn't always a common thing. So I think that a real focal point on kind of how these amenities are being done. But I think leasing in general, the environment now it's a lot more price sensitive than it was before. I think before it was about the amenity war and who's got the best stuff, where I think now people are really taking a hard look at just what that cost is, and it's forcing these landlords to really up their concession game. And but it appears to be working. I think people are coming back to the city and will continue to come back to the city, and fill those babies up.
But you did say one thing was a certainty, and it is uncertainty. So
that's right. We're all. Yeah, it changes daily, weekly, and blah, blah, blah. And that's the worst thing in any situation. You don't know what to do. You feel like you're just taking a guess.
And then Milan, you had something interesting to say about this too.
Sure. So all our suburban properties were typically at between 87 and 94% occupied. And our city stuff was 92 to 98% occupied, and now it's the reverse. So now we're fully occupied in the suburbs, not as much in the city. And when I listened to the previous panelists, they own most in the north side and some in the South Loop, and they said that their vacancy was about 10%. Some of these buildings right downtown are 20 to 30% down. So the summer really dropped. We saw a huge amount of vacancy over the summer. Now it's picked up, but people just prefer to be in the suburbs right now, where the police will come when you call them, where your packages won't get stolen, and retail is not boarded up, and the restaurants are open. and you know, and from the owner standpoint, it looks attractive right now. I used to not like to buy suburbs because the taxes were higher. Now the taxes are higher in the city. So it just has more of appeal from the buyer standpoint,
Wow.
from acquisitions.
I didn't know the taxes were higher in the city. Robert.
City and suburbs, larger units are, in our vision, leasing more quickly. If your unit has a space to put down a laptop as opposed to working on your couch, that's going to be a benefit on your bed. The lease terms have been longer, and this is not my area of expertise necessarily, but from what our clients are saying. And that I guess is due to people wanting to establish a safe place that they can set up shop for a longer period of time. Another interesting one, which may be not long-term necessarily, is looking for additional auto and bike parking, which is related to people not wanting to take mass transit as much due to the issues of COVID. So that may not be a long-term trend, but that's a current goal as well for a lot of our clients.
And Kristen.
Well, I mean, it's pretty well covered, although I will say we haven't touched on as much as what's in the unit. Milan had mentioned people needing more storage. We're just spending more time in our unit. So it can't just be about what you're selling in the building that's amenities. It really is about the size and what's built into the units to accommodate people's needs now that they're spending more time there. And the durability of those materials, just making sure, I mean, we looked at approximate increase of time in that survey of what people were spending. It's 2 to 3 times the amount that they were spending. So think of the wear and tear on toilets and countertops, which Milan, I think you had mentioned how you're handling maintenance issues, which I'll let you talk about, but I just think we have to think of the extra demand on these buildings as part of the whole equation. But to your point of leasing, the biggest shift we've seen is that it's just gone digital, right? So we work very closely with property managers and owners around what is that leasing marketing process going to be and how do we help facilitate that? Where does the leasing office want to be? Is there a leasing office? Is the management on site or off site?
I'm sorry.
Now that leasing's gone more digital, it does beg the question, what does that mean for those spaces in the building? What are the needs actually going to be? Will we be more at an open leasing style where you've got, you know, a bigger lobby space and you have a couple leasing managers that are just down there on laptops with a private room to have meetings? So it will be interesting to see how that evolves.
Yeah, I've seen so many beautiful buildings with these incredible lobbies that are leasing offices by day and common space by night. So what new management techniques and technologies are being utilized to meet tenant demands? That's the whole area of prop tech is so fascinating. Milan, I'm going to ask you to respond to that first.
Sure. So even though we're a dinosaur industry with, you know, almost no technology, and you know, a lot of money has been chasing our industry for the last few years, but I haven't seen anything revolutionary that actually changed much. There are some things that are coming out that we're utilizing. So those are texting, for example. I have a texting app that if a tenant recognizes tenants' questions, so the tenant would text and he would ask for name, unit number, and then what the question is. And if they say, my garbage disposal is not working, it'll say, can I give you quick tips? There's a little Allen wrench down below. Are you able to do that yourself? And it'll give an instructional video. Our maintenance crew has recorded videos that we send out. And we'll give a little bit of rent credit. So it's worked out great because people want contactless everything now. And this has been working well. That's kind of the big one. Another thing is we have this Butterfly software system for package rooms, because there's just so many issues with people steal packages, and now this takes your picture. You have basically you know, a fob to get in and out, and that stopped that issue. So that software has worked out great. We're doing some Zoom socials and champagne tastings with you know, hired sommelier. It's a friend of mine, and you know, we're trying to be creative with technology that we have, but we don't have much to work with. And you know, I installed a ton of cameras recently because of security. So now those cameras have mics. They're high you know, quality, and they have speakers, so our managers can say, you know, well, how can I help you when they're in front of the building? They can speak to them, and that's about it from what I know, besides the Rent Cafe and all the, you know, old stuff. But yeah, we need more.
I have interviewed a lot of people in the past few years who are doing a lot with reviews, and the reviews actually relate to leasing, because and they're using obviously online devices to have reviews, and they're asking for their tenants to do these reviews fairly frequently, because they found that millennials and people who are younger, Gen X, which you know is a huge generation coming up, I mean Gen Z, sorry, will go ahead and make their decisions for renting based on the reviews they see. So it's important to maintain those reviews, and it's all an ecosystem of tech and leasing and the kind of customer service you're giving in your building. Anyway, Robert, you want to add anything to that?
Yeah, the basis in the buildings is to try to reduce the amount of infrastructure that we're adding and reduce those first costs. So the more you can do wirelessly or via apps or other aftermarket pieces that the tenants bring with them, the better. One thing that's interesting is, as we work towards WELL certification and higher indoor air quality, that means that the mechanical systems need to be more enhanced, and the management needs to be able to gather data from those systems and to make adjustments to the indoor air quality as required based on what that feedback is. So there's a bit of enhancement in the mechanical system feedback.
So I'm going to skip, we had talked about how COVID affected management of the apartment buildings, but we've actually pretty much covered that. So I'm going to skip to two quick questions and ask you to combine them because we're running out of time. First is, what construction types are trending in the city and suburbs, and why and how are developers optimizing their projects to get the highest value out of the land? Those pretty much go together. So Robert, I'm going to ask you to take a stab at it first, then we have Richard and Kristen.
Sure. Well, it's a constant search for savings, obviously, and what we want to do is find the most affordable construction type for the scale of the project, and certain ones tend to work better for certain sizes. And so up to 5 stories, we're talking about a wood frame building, typically, maybe not so much in the current environment, but that's what we would typically be working on. For the taller buildings, it's concrete or structural steel. And then there's this zone in the middle where you can look at a technique such as structural metal studs. So that can build up to 11 floors, can be competitive with concrete or better. And that's something that we're seeing in the city now. The city has recently loosened the restrictions on that construction type. So we can now go up to 7 floors over 1 floor of concrete podium with that structural metal stud. So I'd expect to see more of that happening in the confines of the city going forward. And when it comes to optimizing the project in terms of the land, what can you do to build out an entire site? A lot of times in suburban markets, we're looking at courtyards so that you can maximize a bigger block, and it's less about views the farther away you are typically. So we'll build in courtyards and find something that creates a community even though people are looking inward as opposed to outward. Another thing is underground parking sometimes makes sense because you in a lot of zoning codes are limited by the number of stories that you could build above grade. And it's a situation where one more floor of residential can be a big benefit that you wouldn't get if you had to build parking above grade. Unit depths, the deeper a unit is, and the narrower it is, the higher the efficiency of the floor plate can be. So you want to optimize those dimensions and get things to be as narrow as they can be and still be comfortable, and as deep as they can be and still have the amount of natural light and comfort that you'd be looking for. Larger units actually tend to be more efficient because empty space is cheap space. So a studio unit that's 250 feet has a certain number of fixtures, and a studio that's 450 feet would have that same infrastructure, and then it would just have a lot more empty space. So whatever the market is able to pay for, the bigger that it is typically going to be more effective.
Got it. Richard, you said some really interesting things about speed to market strategies and why we have that now, and maximizing inches. So let's talk about that.
Yep, we don't see building types changing that much. Low rise is always going to be wood and light gauge. High rise is always going to be concrete. What's interesting is in the middle of it, we see that's where the fight's starting to happen, where the light gauge and the timber, the particularly mass timber, is trying to encroach on that mid-rise space. They're experimenting with it, and we'll see if we get there. The big change we have seen is it's all about speed to market, especially in kind of these times of uncertainty and changing demographics and stuff. When a developer zeroes in on a plan that works, they want it right now. And so that's what we really get challenged with, is how can we build it faster? What can we do differently than we did before to get it to leasing?
And Kristen, you talked about scale and how the amenity war is over, and it's other things now. So tell us about that.
I mean, honestly, the way that at least our interiors team, everything that Robert and Richard said in terms of the architecture is still very true. It is about cost, it is about speed, it is about scale and location to maximize the building structure to its fullest extent, which involves zoning and neighborhood approval and all of that, which can be challenging depending on the neighborhood. But once it pencils out to the point of what Richard said, speed to market, it has to be marketable. It has to be something that people are excited about, that puts you in a place where you're starting to give your competition or your neighbor a run for their money. Because frankly, yes, there is a lot of moving going back and forth. And I agree with Richard saying that probably in about 2 years, we're going to be looking at, not enough units, but for the next year or two, we probably do have enough, and it's just going to be trading horses. So you got to be the prettiest horse in the parade. So you've got to have something that really moves people and excites them and gets them to cross your threshold and check it out. So really focusing on experience and what the needs of the users are, which should be in balance to the neighborhood and what the neighborhood itself already has to offer. So, we work with a lot of developers that try not to overbuild to the point that Richard was saying. I don't want it to be just more and more and more is better. I want them to be smart. I want them to be adaptable and responsive to the community needs and the neighborhood needs. So that's what we focus on.
I want to thank you all. We have a couple of questions from the audience, but we are out of time. And it's because, as you can see, my panelists are also knowledgeable and have great things to say. And they really prepared hard for this. And I am very grateful for the time you gave me before this. And thank you all. Todd, back to you.
Wonderful event. I think we're going to have a call with our Chicago team. If you're listening right now, this needs to be longer. Y'all have so much good to say. A longer event, I think, is in order for next year.
Well,
Our
my family-
multifamily
oh,
event in
great.
Minnesota is almost 5 hours, so
Yep.
good stuff.
No,
Well, thank
yeah.
you, Lisa. Thank you, panelists. This was fantastic. Again, don't forget to check those boxes on the LinkedIn, connect with these speakers, tell them hello. Looks like a lot of things got asked and answered in the chat room. Appreciate everybody's participation. Really appreciate sponsors. I'm going to throw their slide up one more time as we sign off. So y'all can feel free to shut down your cameras, microphones, and say sayonara. Have a wonderful weekend.
Thank you.
Sayonara.
Thank you all.
Bye, thanks all.
Thank you.
Bye, guys.